Welcome to the Banking with Life podcast. This is our Q&A series where I answer your questions regarding the infinite banking concept, becoming your own banker. Let's get started. In this question, what is adverse selection? I think this is a question on life insurance PUA episode. Technically adverse selection in the marketplace is when one party knows more than the other party or has knowledge that the other party doesn't have. And when it comes to life insurance and on the paid up additions episode, that I'm talking about paid up additions, in the context of paid up additions, here's an example of why I even brought that up. So, and not every company, some companies, if I pay, let's say $1,000 to the paid up additions rider, a portion of that goes to cash value after the charge, and the charges are between 6 and 14%. A lot of these companies out there can charge you 14% and more if you're rated on a PUA premium. Oh, but that's dug down in there so you can't find it. Okay. And then they have the right to increase it. A lot of them do, right? Whether they're at 8% or 9% or whatever the charge is. So the companies do matter. Their practices do matter. Just as much as the structure of a policy does matter. I don't care what they say on Reddit. I don't care what they say on the private Facebook groups. And it's not my duty to prove to them my position. Okay? Again, somebody's understanding of life insurance, like most people, and I'm saying them, is based on someone else's misconception. Or maybe they're in an echo chamber and want their own position and opinions confirmed or supported. And I'm not obligated to do that either. Okay? All right. So that's technically what adverse selection is in the marketplace. One party has more information than the other party. In the context of a paid up additions rider, the example that I was alluding to would be akin to if I was able to pay $1,000 in PUA premium, the death benefit, depending on my age, is going to increase. I might buy $1,000 in death benefit, additional paid up insurance, right? Paid up additions. What am I doing? I'm buying additional death benefit, and it's paid up additions. Okay. So if I put $1,000 in and say I'm a young person and it buys 3 times the death benefit, paid up, I put in $1,000, now I have $3,000 in death benefit. When it comes to adverse selection, the companies that have that ability, and maybe I have the contractual right to put in $100,000 to the paid up additions, and it's automatically going to give, or create an additional $300,000 in paid up additions. The adverse selection, and the companies are very aware of this, and that's why they go through and modify their products, from time to time. But once a policy is issued and delivered, they can't change that unless they're adding benefits to you, and you're going to be notified if that were to occur. Okay. And I know firsthand that some of these companies have learned the hard way, right? Where somebody has a contractual right to put $100,000 into the PUA in the form of premium, right? They're paying additional paid up additions premium, but they didn't exercise that right. Okay. But then they discovered they had cancer or some kind of terminal illness. And then they run out and put $100,000 in. That's the exact example of adverse selection that I'm talking about. The companies don't want adverse selection against them. Okay. I hope that helps. Are U.S. life insurance companies holders of gold and silver? I do not know the answer to that question. I was going to ask, the people that I know and have relationships within the industry. I don't believe there's a restriction on the life insurance company holding precious metals. There may be a limit. I don't know. But, look, precious metals, they don't have a cash flow, right? And I'm sure if I don't know. I'm not sure of anything, but I am sure a lot of people are taking profits in precious metals, because they're up. And there's a whole nother episode on precious metals. Okay. But so I don't know whether life insurance companies hold gold or silver or any other precious metal. And I don't know if there are limits. If they do, I don't think there are any restrictions. So I may have to put a caveat on that and, confirm with a few life insurance companies, get their input. Then this question, I forgot to mention, he notes that China now lets insurance companies invest in gold. That's, perfect with these types of questions. That the questioner, the person sending in these questions are diving deep off into, gold bugs and all kinds of stuff on the internet, which some may be good, some may not be, but we are not going back to a gold standard. It's not going to happen. Okay. And then I pretty much said, well, to my knowledge, there's little to no restriction whether life insurance companies hold precious metals. China does a lot of things that the U.S. and other countries should not do. They kill babies. They pollute the world. They pollute waters. They oppress the working class. They oppress, and did I mention they're communist, which by definition is anti-capitalistic? Fundamentally, the life insurance companies hedge against inflation with real asset holdings, lending practices, and investments, which their investments do include bond. That's how I answered her. Episode 268, direct versus non-direct recognition. What's the real difference? Comment. Also, companies calculate outstanding loans when calculating how much dividend to pay. So the dividend for everyone is lower because the outstanding loans. You just don't see it. No, that's not, do they somewhere in their formulary consider the outstanding loans in their calculation? Yeah, but you don't know which company does or does not and how they do it. Neither do I. And don't pretend you do. I know this is an individual as an agent because the premise of this is that because there are outstanding loans, everybody's dividend is reduced. And I've talked about it through that direct and non-direct series. The implication is the idea, the promoter, the direct recognition companies and the promoter of direct recognition policies assume and put forth as truth that a non-direct recognition company, one that does not lower the dividend on an outstanding loan, lowers everybody's dividend. It's not true. It's an adjustment. I pointed that out. I gave the document from two different companies, one direct recognition, one non-direct recognition company. The assumption from a direct recognition company that directly recognizes an outstanding loan is that every dividend is reduced because of outstanding loans. Man, that may sound good. It may have sounded good to you before you printed it. It's not true. And I've covered it through the direct and non-direct recognition little series that I did. You're commenting on 268. It's like, no, and no. The assumption and the accusation is as if it's truth. It's promoted as if it's truth and factual, and it is not. The assumption is every non-direct recognition company reduces the dividend already, prematurely, prior to paying the dividend. It's an assumption that there's a lower dividend because they don't reduce the dividend on an outstanding loan. Am I saying at the end of the day it's going to be a life or death difference between a direct and non-direct recognition company? No, I'm not. But if you go buy a policy to practice the infinite banking concept and you're going to actually have loans outstanding over some kind of a time period, could it matter? Yes, I'm saying it could matter. And all of you promoters of direct recognition companies, you can create whatever you want to. By gosh, you will. There's no question. But just because you say it doesn't mean it's right. And you can put that back. Well, just because I say it doesn't mean it's right. That's no question about that. So go and learn. The encouragement is to learn. I hate being hard on life insurance agents, but dang, quit being part of the problem. How about? All right. In this email, an individual is just trying to wrap their mind around and I'm being graceful. My assumption is that, it's all good intentions, trying to wrap their mind around the infinite banking concept. And so, although they've said, or implied that they've read the works, Becoming Your Own Banker, how privatized banking really works, building your warehouse of wealth. And okay, I don't know how much a comprehension, is retained. I don't know, but they're trying to wrap their mind around it. They said they've read these works, and I believe them. But then they continue, and their continuation is to talk to everybody, within the infinite banking footprint, right? And here's a statement, they modeled a plan significantly reducing the overall premium in year 6. I wonder why they did that, and you should understand the effects of that, why you may want to do that, but why you may not want to do that. Right. Oh, the idea was to free up cash to purchase another policy at that time. Sure. Buy another policy every 4 years, every 6 years. So you are continually in the startup phase. Continually. What I mean? Well, every policy has a startup period, right? Yeah. And then you're going through underwriting. I don't know how old you are, but you're going through underwriting every 6 years. Or in this example, right? And so they're comparing one, quote unquote, sales presentation to another, and they don't understand the difference, which is fair. Go back to Nelson's basic work, Becoming Your Own Banker. How to Buy a Whole Life, a framework for the infinite banking concept. Ryan Griggs lays out very well, covers that very well. Any reason to choose a separate term rider as opposed to a blended or combination rider? Yeah, talked about that many times. PUA, duration. There's 700 videos on this channel, YouTube, James Neathery, Banking with Life. And I know a lot of them are shorts. I understand that. But this is 53, 4, 5, a Q&A series. There's a whole series of Q&As. Spend some time educating yourself, learning, right? And don't take my word for it. Listen to what I say and go apply it against everybody else or whatever, whomever you want to, and listen to what they say. It's like, God bless you. But there's a ton of information out there. Not all of it agrees, right? Everybody in the infinite banking footprint does not do the same thing. Right? Everybody at the infinite banking concept that practices the infinite banking concept, they do not all do the same thing. So you as a consumer, if you can't listen to someone or read what they've written, right, and make a fairly reasonable determination of whether you'd want to work with them or not, don't work with anybody until you can, is my encouragement, right? Okay. They go on. And this email is referencing some other individual that, quote unquote, practices or promotes infinite banking. She made it seem that money could be borrowed from the policy to pay for a new policy. No kidding. Wonder why that would be. Yeah, several episodes we have recorded on that. But then this individual, but I've heard conflicting views on this. No kidding. You're going to hear conflicting views your whole life, and you're going to hear conflicting views within the infinite banking footprint. This comment was in the form of an email or contact. It was a contact form from our website, bankingwithlife.com. I just want to say a huge thank you to James and Ryan for the Banking with Life podcast. I live up in Canada, and I've heard about IBC for years. Started searching and found your podcast. You guys have kept me out of a lot of trouble and helped me to grow my knowledge and understanding of the infinite banking concept over the last 4 years. I've been practicing IBC for the last 3 years. Within the last 12 months, my family and I had some unexpected emergency expenses totaling up over $20,000. And I praise God to be able to deal with these problems quite easily due to the participating whole life policies that we own. Thank you again, and for your ongoing fight to help people. Like me, cutting through the noise, I can't wait to get into the next life and meet Nelson. All right. Thank you for listening. Thank you for the positive comment. Yep, and there's this life, and then there's one more, right? And hope to see you there. I will see you there, okay? In this is episode, the connection between infinite banking and Nelson's grocery store. Yeah, I was kind of hesitant to whether to address this as part of a Q&A or a commentary, but I think I'm going to, but it really needs a larger work. It says, hi, James. Question I can't figure out is, where does the numbers come from in the grocery store example that we need to turn over our inventory 15 times just to break even, 17 times just to make a profit? Can you help me understand that? Well, on the numbers, it would take a larger work, but the can of peas, there's a 3 cent profit on a can of peas, right? The grocer sells a can of peas for 60 cents. It cost him 57 cents. He's got to sell, 15 cans of peas just to break even. And so there's that, and you know that, and I'm just repeating what you've said, what you're referring to, and what Nelson said. 17 times it can make a profit. And he goes on to say, sell it, I think 20 times, and you can retire early, if I'm not mistaken, and becoming your own banker. If you look at that, it is, and here's a comment to that comment. And this gentleman says, well, I suspect it has to do with velocity, as in on a monthly or annual basis, how fast you can turn over the inventory, so that light, building costs, heating, cooling, staffing costs are covered, and there's something left for profit. So if operating costs come after gross profits, which is revenue minus cost of goods sold, you may need to sell large amounts of goods to cover the operating cost even before the profit appears, which I agree with every bit of that. There is velocity. It's not how much, and there's a lot there in the grocery store section part of Nelson's book, Becoming Your Own Banker. And I can't wait to do a larger work on that, because, man, you can apply that pedagogically, as Ryan likes to say, and it's a beautiful thing. If you're only making 3 cents on a can of peas, you have to sell a lot of cans of peas, right? Just to be profitable. And it has to do with velocity. There's no question. And velocity is how fast, right, something goes through a system, the money goes through an economy, and how many times. So, I'm not going to get rich practicing the infinite banking concept due to my financing activities. If I only finance one card, there's only a certain amount of profit that I can capture from that. The equivalent of the interest that I'm paying someone else, I get, to enjoy that through a life insurance policy. And there's a lot there, page 59, what is this additional interest? But it's how many cars are you going to finance? How many times are you going to finance? And so there's a lot there. I probably shouldn't even have brought that question up, save it for later work, but it does have to do with velocity. It's how many times are you going to finance something through your life insurance policy? And then there are ways to do that. Right? Do I want to finance $1,000 grocery bill every 2 weeks through my life insurance policy? No, I don't, because I don't want to drag the home office through that. But if I spend $1,000, just as an example, if I spend $1,000 every 2 weeks, somebody's getting pretty fat and need to cut back and practice Parkinson's law. But for an example, if I spend $1,000 every 2 weeks on groceries, and I factor in the opportunity cost, which is a fundamental economic concept, right? The opportunity cost, if I didn't buy the groceries, I'm going to starve and I'm not going to get fat, probably, or as fat. But that money could have done something else. The other thing, the opportunity cost. So if I'm going to practice becoming my own banker, and I'm going to practice honest banking, I should recognize the cost of that capital. that $1,000, right? So does that mean I want to pay $1,000 and then 2 weeks later get a loan from the life insurance company, drag myself, my time, effort, and energy to do that, drag the staff of the life insurance company through that whole process? No, I don't want to do that. But if I value my capital, and I do, and I put a numerical value on the value of my capital, and let's say it's 10%, can I send, in this, my example, and I know on an annual basis, to every 2 week grocery purchase, can I just pay an extra $10 to the PUA if I have room at 10% of $1,000 every 2 weeks? I know that comes out a dramatic number on an annual basis, but yeah, I can do that. I can just send the company $10, or I can put $10 on the side, whatever the minimum premium, additional paid up additions premium there is into the PUA. I can do it that way. All right. Now you can say I'm playing games, and I may be playing games with myself and my cash flows and my capital, but I am practicing, right, valuing my money, my capital at a particular rate. All right. So that's just one example. Okay. I could go on, but my schedule will not allow me. So I must say farewell. Goodbye. See you next time. Thank you for listening. Thank you for listening. If you have a question that you would like answered, email me at james@bankingwithlife.com. Thank you for listening. Have a great day, and we'll see you next time.